I'm Ernie Humphrey, Educational Programs Leader for Proformative, the largest online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar, Raking in Revenue, Optimizing the Order-to-Cash Cycle by Automating Accounts Receivable. For most organizations, the order-to-cash cycle is a complex, multi-step process that involves order creation, fulfillment, shipping and distribution, invoice generation, payment collection, receipt, and finally closing the books. AR automation not only helps shorten the cash conversion cycle and improve operational excellence, it also allows financial executives to build a solid foundation for a holistic, sustainable order-to-cash cycle. Today, our speakers will focus on how leading organizations are leveraging accounts receivable automation to fuel business growth. They will focus on actionable advice and best practices for improving AR efficiency, as well as real-world examples illustrating how manual process can impede response time and customer service. I'd like to thank Transverse, whose commitment to thought leadership helps us make this webinar possible and delivered at no cost. A quick word on today's agenda. First, we'll hear a brief presentation from each of our featured speakers. Then we'll move to our interactive Q&A session, where we'll spend the remainder of our hour. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we'll do our best and we'll follow up afterwards on any questions that we did not get to. A few more logistical notes on today's webinar. A link to today's presentation and video of the webinar will be sent out to all attendees within 24 hours of the event. And also note that as we have a technology demo, there will actually not be eligible for CPE credits today on today's webinar because there's a technology demo. We encourage you to ask questions on today's topic via the questions box in your GoToWebinar control panel at any time during the webinar. Finally, you'll be asked to take a short survey today regarding the webinar. We greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A quick word about Proformative. Proformative is the largest online community and resource for senior-level corporate finance, accounting, treasury, and related leaders. Proformative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges they face every day. Okay, let's get started by introducing today's first speaker, Ankita Tyagi. Ankita leads the financial management and governance, risk, and compliance practice at Aberdeen Group. As a researcher, she covers topics such as accounts receivable and accounts payables, treasury and cash management, financial consolidation, and reporting. Other areas of her research include retail and corporate banking, supply chain finance, tax management, and different aspects of financial operations. Prior to joining Aberdeen, she worked at State Street Corporation, where she gained insight into bank financial services and the types of technologies leveraged within the Securities Finance Division. Ankita has a BS in electrical engineering with minors in math and business administration, and an MBA with specialization in finance, both from the University of Maine, Toronto. She also has a graduate certificate in leadership and financial services from Northwestern University. With that, it is my distinct pleasure to hand the floor over to Ankita Tyagi from the Aberdeen Group. Ankita, please take it away for us. Thank you.
Thank you, Ernie, and thank you everyone for joining us today. Really looking forward to this webinar on AR automation and how it can optimize the order-to-cash cycle and what benefits can organizations derive in terms of the ROI. So looking forward to this presentation, and of course to be supported by Transverse. That will be great. And then in the end, we'll have some Q&A, as Ernie mentioned earlier, so look forward to some of your insight as well. As for the agenda, we're going to start off with Aberdeen research background. Aberdeen has been around, for those of you who are not familiar with Aberdeen Group, for about 25 years, and we have a tested methodology called the PACE methodology, which is really an acronym for Pressures, Actions, Capabilities, and Enablers. And I'll go into detail on that particular methodology in a bit, but just wanted to let you know that the reason we're presenting these findings are based on extensive studies across different executives, especially at least for this particular topic. We focused on accounts, billing departments, CFOs, CEOs who might be involved in any of the e-payables initiative or anything on the billings and automation side, or even cash allocation when you're talking about the O2C cycle. After the Aberdeen research background, I'll present some of the research findings which are based on this particular methodology, followed by recommendations. And I think the recommendations for the most part will be evident as we proceed through this presentation, because they pretty much jump out at you when we're talking of the ROI, when we're talking about expediting processes, reducing error, enhancing customer relationship, or managing your cash flow. So those are some of the recurrent themes that we come across as we go through the findings. And then I'll hand it off to Chris, where Chris will be presenting Transverse solution, and of course followed by case studies, so that you can tie all the pieces both from research side and from the solution provider side to really see how it actually plays out in real life or in practical business cases. So what is a hypothesis? One thing I want to let all of our attendees know today is that the order-to-cash cycle, or the AR, subject matter as such, is pretty much an annual study with Aberdeen Group. We've been covering this for about 8-9 years. We do this as an annual report. And then we also do another report, an annual report on accounts payable. In fact, a recent accounts payable report just came out. So we pretty much update stats on this particular topic each year because we feel that more and more executives want to know about this. They want to know some of the emerging technology trends that are occurring in this particular space. They want to know what they can do to optimize the processes. In general, most people think, you know what, order cash is a simple process. You know, all it involves is really you take orders, you deliver products or services, and then you get paid. But in reality, based on our hypotheses, we find that order cash is a fairly complex multi-step process because it really starts off with order management, credit fulfillment, then you're going into billings collection, dispute management or resolution, and then you have the cash application, which stretch beyond accounts receivable, and of course, as you may imagine, as I'm sure quite a few might know, the intertwined with sales, manufacturing, and supply chain. And then if you throw in the compliance aspect, you know, who's approving these invoices, who's billing, who's keeping track of it, then you have the finance executives, their interest peaks as well. So the reality is that the order-to-cash cycle is a fairly complex process, and in order to optimize this entire cycle or to receive the maximum return on investment, you need to look at all the sub-processes and understand what some of the inefficiencies are and drive efficiencies across each of them. So the second bullet point is pretty much what I just mentioned, that it's often fraught with cumbersome manual processes, which can delay the entire cycle, which can extend the DSO, the day sales outstanding, which can really impede the cash flow and the visibility into the financial position as well. Because imagine most of your suppliers, anyone basically who is, you know, either wanting to get paid or even anyone, say your buyer, is really waiting on an invoice, is really waiting on that bill to arrive in the mail or to be faxed or whichever medium you're using, assuming it's not automated, to really arrive and then start paying. Therefore, what you're effectively doing is that you're delaying the cycle, and because you're delaying the cycle, there's not an electronic system in place. What it really does is you're delaying the cash flow to the organization, and ultimately it's impeding the financial visibility, which is a very important function within the office of the CFO. But so we believe that AR automation is one way by which organizations can overcome this particular challenge because they can expedite the processes. The AR automation is fairly scalable, so if you have sister companies, if you have subsidiaries across different units, perhaps you're using a cloud-based solution, perhaps it's something that doesn't have to be deployed on-site, it's something that can be off-premise, that more and more subsidiaries or sister companies can use. It is also less error-prone because it is automated, so instead of relying on manual intervention, a human who's actually keeping track of bills and has something being mailed out and not, has the fund being allocated, has the cash being allocated once you have received the payment. Instead of doing all that, it is less error-prone because it relies on electronic medium. And of course, the cost reduction element is something that we find happens quite a bit with AR automation, primarily because you are reducing the overhead cost in mundane tasks. You can redirect your workforce to more complex and analytical tasks. So you are productively employing most of your workforce instead of somebody whose job is just to keep track of bills and just to mail them out, or just to ensure that a fund is allocated when it's received or the cash is allocated. Therefore, one of the emphasis in today's presentation is to get the message across that billing is in fact a critical component of the order-to-cash cycle, as I've just mentioned, and it warrants a bit more attention because it's one of those steps that I personally feel, based on lots of conversations with end users, that once the order management happens and credit fulfillment happens, it's the billing and the collections which kind of get a little iffy, and especially if you have a subscription-based model. By not going the automated route, you're really creating a lot of work for you, and you're really losing out on the actual value proposition of having an effective order-to-cash cycle. And then finally, The other aspect that I just want to touch upon briefly in today's presentation is the need to integrate this with existing ERP or financial reporting systems. Because as I mentioned earlier, ultimately it's all about cash flow, so you need to tie it with the existing financial systems to really see what has come in, how much cash has been allocated, what bills are outstanding, what payment has already been received, and to match it up with the existing financial system so that the CFO, the executives have visibility, which will really help with financial planning and forecasting. The following slide that you see, it talks about the PACE framework or the PACE methodology. As I mentioned earlier, Aberdeen has been around for about 25 years, and we follow what is called the PACE methodology, where PACE is an acronym for pressures, actions, capabilities, and enablers. Pressures are really the external and internal market drivers which are compelling organizations to undertake any kind of technological initiative or any kind of enhancement to their current processes or operations or functions. Actions refers to some of the key strategic actions that these companies are taking to alleviate the pressures, and we find that since most organizations are pretty much interconnected, we are working in the same global dynamic environment, the pressures are the same. Where companies outshine or some companies lead compared to others is in terms of the strategies and the capabilities. Capabilities are really their organizational process capabilities, performance management capabilities, and knowledge management capabilities. And again, we find that the leading companies or the leaders or the best in class outperform their peers, their followers or the laggers or the companies that don't do well, both in terms of strategies and capabilities. They tend to be more proactive on both these fronts compared to some of their other peers. And then enablers refers to some of the key technology solutions that companies are using. And because Aberdeen model is vendor agnostic and we're reaching out to the end user, we're really trying to understand the broad range of technology solutions. So we're not pitching this technology solution, we're really trying to understand if it's e-invoicing, if it's procurement networks, if it's an automated billing solution, or if it's a cloud-based deployment method that's working. So our general sense is to grasp the entire picture so that we can paint a strategic vision for organizations which are considering order-to-cash automation. But what do we actually do with this PACE methodology? The intent of the PACE methodology, as you can see on this particular slide, is to really come up with the maturity class framework. What we are trying to do is that based on this benchmark survey, this primary survey that we launched to the community and asked questions across the PACE methodology, across those 4 acronyms, and certain key performance indicators, we tried to classify a respondent base into 3 categories. The first category refers to the best-in-class companies who are the top 20%. The middle category refers to the industry average, who are the middle 50%. And the last category refers to the laggers, who are the bottom 30%. Now, how do we categorize our respondent base into these 3 categories? Really depends on the performance across key performance indicators or the KPIs. So on the left-hand side of the screen, as you see, there are 3 KPIs that we've listed. Typically, we ask tons of metrics. We ask about their operating cash flow, their net income. We ask them about their day sales outstanding. If we are talking about e-payables, in the payable space, we might ask them about early payment discount capture rate, how many invoices do you process, etc. But for this particular study, the 3 metrics that we used as qualifiers were the percentage of AR accounts receivable that were past due, the number of days to clear the ledger, the AR ledger, and finally the extent of manual intervention. Because we believe these 3 metrics are really a way to gauge the performance of leading companies compared to some others, and the best-in-class companies do very well across these 3 metrics compared to some other metrics. The next slide that you see is really talks about what the value is. Why are we coming up with these classifiers? In the end, what are you going to accomplish? I think by now you must have understood that what we're trying to accomplish is really distinguish, find those points where the best-in-class outshine others, and basically kind of provide or feed a map, a roadmap based on the best-in-class performance to companies who are not doing well. So the intent is really to drive the point home, what are the best-in-class companies doing differently, what pitfalls can they avoid, and how they're achieving greater success, and then finally, what technologies are they deploying or they're cutting edge for them that they believe will lead them to the next step. So the intent is to really serve as a roadmap for laggers and industry average. So what were some of the key market drivers? When we reached out to a community to really ask them what were some of the key market drivers for them to automate their AR processes, for them to optimize the order-to-cash cycle, the first and foremost was the pressure to reduce day sales outstanding. They want to wrap it up. They want to, if the deal is closed, if the invoice has been sent, the orders been managed, etc. They want the billing to go on very smoothly, very effectively, so that they can collect the revenue. And honestly, in this environment where liquidity is still a concern and credit might be tight, if you can generate ongoing operating income or cash flow, then it's definitely healthy for the organization, and ensures also that you can better forecast and plan ahead and allocate resources based on what's happening with your billing cycle. Then, of course, there was a pressure to reduce overall costs, which was cited by 45% of the respondents. That's the second biggest driver. They do believe, many executives believe, that some of the manual processes are not only eating into time, but also eating into the cost. It takes longer, so you're processing things much slower. Therefore, you're missing out on some of the benefits of automation. And they felt that there was an overall need in a way to reduce the cost. The other things that you notice is customer pressure to extend payment terms. And of course, this is because of the liquidity environment. Even the customers, if they're struggling, they want more time to really benefit from the payment term. But in fact, we found, based on some other studies, that it's not necessarily extension of payment terms that benefits customer all the time. It's finding that optimal point, at least on the payable side, on the AP side, to realize that, you know what, a 20-day point is most productive for me, because then I get some sort of early discount capture rate. I can actually have an early savings discount or dynamic discounting or factoring to come in depending on what role you have. So we've realized that this is a mentality that some of them have, and it tends to stick with the receivable side as well. But in reality, if the customers are savvy, they want to optimize the payment cycle, not necessarily always extend it. The risk of customer non-payment to default, if the bill hasn't been sent out, it's been lingering for months, there's a high chance that the customer might default or might dispute it, might say, guess what, we don't have a record, we were expecting in 90 days, we still haven't received the bill, I guess. We don't owe you anything. So those are some of the key market drivers that we have seen. And then this year, as I mentioned, since we do this as an annual study, the pressures were even more compelling, and I really want to share them because I was looking at the data this morning, basically. And we found that there were even bigger drivers on the billing and automation side. One of the things that came up was that they want to manage, companies want to manage their credit risk and losses from bad debt and collection expense. And in fact, 42% of the respondents believe that they're suffering too many losses from bad debt and collection. So they don't have the right type of skills to collect. And also, 43% cited that they want to improve their billing accuracy and underbilling for revenue assurance. So they want to improve their billing accuracy. They want to ensure that all the clients are billed in an appropriate manner, in a timely manner, and then it needs to be more accurate. This, again, ties in with more financial visibility, more transparency, and for better planning for the future. So as for the billing system, I've spent quite a few minutes on billing systems, so I just want to give you an overall health check on where billing systems stand. And based on the study that we did last year, we found that 47% of the organizations currently have a subscription or a recurring revenue business model in place, and 47% is fairly substantial in my opinion. And one of the benefits of AR automation, especially the order cash cycle to optimize, is that if you do not have to, if you know that you have subscription or recurring revenue business model, to me, at least personally, it seems a bit silly to go through the same drill month after month or 2-3 months later, where you're billing manually, where you're sending out bills and keeping track of them. If you know there is a customer who has a certain pattern and you know they're going to spend with you again, or it's a recurring revenue, then you want to have an automated system where the bills are sent out automatically so that you're not chasing them constantly, so that you're actually directing your workforce to the tricky accounts where you feel there is a chance of default, or maybe where you can tailor your payment terms a bit, so that when you send out your bills, you actually receive them. So to expend that amount of energy in recurring revenue seems a little bit waste personally to me, And I think many organizations are realizing that they are currently very dissatisfied to somewhat dissatisfied with their system because of the extent of reliance on manual effort that goes into tracking this billing system, and about 35% of the respondents cited dissatisfaction. And then 81% are using a mix of somewhere between recurring services and one-time purchase offer model. So those are even trickier. So because now you want to keep track, you want to separate the two out. So you want to make sure which one are recurring, which of the billing needs to happen on a regular basis versus which is just a one-time purchase. And I think to rely on those processes just manually, it can be pretty cumbersome. And if you have multiple interactions with, say, the supplier buyers, you have multiple interactions, it's just convoluting the system even more. Only 32% of the organizations have some applications in the cloud, where we do believe that the number is going up. In fact, mobile technology is another trend which is coming up. For the most part, mobile is pretty low when it comes to the billing side at the moment. But in general, there's some areas, other areas within AR that we're noticing that the mobile is gaining a lot more traction. But what are some of the key challenges with billing, and why is the cycle so slow, or why are people expressing dissatisfaction? I think first and foremost is lack of staff resources or headcount. Somebody manually keeping track of these bills, and then once the cash is received, allocating it, it just adds to tedious processes. And then you have difficulty consolidating information from multiple data sources. This is extremely critical, especially if you're interacting between, say, procurement, finance, and sales department. How do you keep track of these different systems? What if you're using a different system? Are you updating each of these, say, assuming spreadsheets? A lot of companies still use, unfortunately, spreadsheets, and they're not going nowhere anywhere. Are you updating these systems manually? You're losing out a lot of time. There's no consolidation. And because there's no consolidation, any changes in one system do not necessarily permeate to the other one, and you can't see the whole picture as it stands. So what are some of the key strategic actions that companies are taking? And again, this compares to the leaders to the followers. For this particular study, what we decided was that instead of going best-in-class industry average and laggard route, we would go the top 30% who are the leaders, and remaining 70% who we call the followers. And we find that, remarkably, as you can see in this particular graph, that the leaders are more than 2 times as likely to increase the use of electronic invoicing, 57% versus 25%, so it's more than twice as likely. So they're relying on e-invoicing. They're also streamlining the administrative processes to remove non-value added steps. And even though you find that the leaders are less than the followers here, these are the current strategic actions. It's because they already have done. Most of the leaders we find have already streamlined the processes. So these are more reflective of the future realm or where things are moving. It doesn't necessarily mean that followers have streamlined more of the administrative processes. It just means that the leaders have been more proactive in this particular area and have actually streamlined most of the administrative processes. And in fact, they're looking at step 2 within those processes, which is fine-tuning the existing processes. How can you lead to continuous improvement is the next mantra for them. So there's a slight difference when you have to interpret this data. They're also investing in automation of AR processes. Again, similar to what is happening, it's not that the leaders are slacking off in terms of AR automation. We find that they have been more proactive on this front. So for them, this is becoming less of an urgent strategic action compared to fine-tuning the existing system and compared to finding another or new area how they can integrate these different systems. In fact, 2 themes based on my conversations with lots of executives are that, first of all, these leading companies or the best-in-class companies have already done automation. They get that. They have that as a foundation layer. The 2 areas where they're really focusing these days now are, one, on continuous improvement. How can you make the existing systems better? How can you remove any type of non-value add process? How can you automate even further and further? So they're really enhancing the existing systems. Can you provide unstructured data? Can you incorporate additional BI tools, the analytical tools within the existing capabilities? That is one. The second aspect that they have really started looking at is how can they integrate with the existing ERP solution. And in fact, they're extending it beyond not only the ERP solution, but it's a compliance solution. How can they integrate financial reporting, a record-to-report system with ERP, to a compliance solution, to maybe an entire tax solution? So they're really looking at continuous improvement and integration. So what are some of the key capabilities? As I mentioned earlier, these are some of the areas where the leaders really outshine the followers. And you can see from this particular slide that the billing and collections are integrated with order entry. And again, we find, as I mentioned earlier, that the best-in-class companies are more focused on integrating the systems. And again, it's almost twice as likely as the followers, where we find they're at 70% compared to 37%. And they're trying to remove the data entry aspect or keep that in check. Then they also have standardized enterprise procedures. Again, by having standardized enterprise procedures, there is consistency within the organization. Everyone has same expectations, and what that also helps with both standardization and centralization, which you see in the next point, is that it provides some sort of uniformity across different geographic units. So their sister companies which are spread across the globe or even across the country, by having standardized and centralized system units, they know what to expect. There are better compliance policies in place. There is more uniformity in the collection method, in the billing method, and they do reap rewards in terms of resolution, dispute resolution as well. The other areas that you focus on in this particular slide talk about real-time visibility into both invoice volume as well as exceptions. And what that really does is really builds the case for excellent customer service. When you have real-time visibility, the executives can prioritize what's a bigger dispute, what's a bigger concern versus something that is not. And they can actually adhere to some of the bigger customers. For instance, if there's a customer who's spending over $1 million and you realize that there's a dispute with them and they are perhaps in the recurring or subscription-based model and they have been your loyal customers, as an executive, it's very likely that they might feel that this is a big invoice amount and they have been a loyal customer. By escalating or by pushing these kind of notifications up in the queue, by having a real-time insight, executives can address them well. And then on the technology side, we see electronic interface to bank, performance dashboard. Performance dashboard, again, is intended to support the continuous improvement initiatives across leading companies, the leaders, and the best-in-class. So they're really tracking and measuring which systems are doing well, which are not doing well, and what are some of the areas in need of improvement. The next slide, sorry, I skipped a couple slides. This slide talks about the key performance indicators, where we are really comparing the leaders to the followers. They're pretty straightforward. As I mentioned earlier, we looked at 3 key performance indicators: the percentage of AR past due, the number of days that it took for the payments to clear the accounts receivable ledger, and the extent of manual intervention. And you can see pretty much across all metrics, the leaders outperform the followers. Their AR past due is much less. So you can imagine with the cash flow, especially if you're dealing in millions of dollars, that leads to pretty substantial cash flow upside for the leaders compared to the followers. The number of days for payments to clear, this is really sad when I looked at it, 1.1 versus 6.9. The difference is significant once again. And almost 3 times, it takes almost 3 times as likely, or the followers are almost 3 times as likely to have manual intervention. So they're not relying that much on automation as we find the best-in-class companies are. Now, I mentioned earlier that it's very important to integrate, and that in fact the leaders and the best-in-class companies are focusing quite a bit on integration. But what is the reason for integration? We did another survey not too long ago in August of this year, which was really around the theme of integrating different workflows, whether you're talking procure to pay, order to cash, record report, employee expense management, supply chain management. And the goal was that how many multiple feeder systems do organizations have, and what is the cost of this particular system or having a custom system and then integrating that system. And it was found that organizations can have anywhere between 5 to 12 multiple feeder systems, and on average they have about 7. And the cost of custom development per feeder system, as you can see from this graph, is almost $260,000. And then when you're trying to integrate that system into your core or general ledger system or a core accounting hub, it's another, say, $290K. So 260 plus 290K is over $500,000. It's about 550,000 for my quick math here. So you can tell that the cost is so substantial for organizations that they realize that once they've automated most of the sub-processes within a workflow, say for instance in the order to cash, they still need to tie the different sub-processes together to really drive the benefit. Otherwise, if they're operating in silos, there is extensive amount of cost, and the cost is not only in terms of qualitative aspects where we're talking about latency and poor customer service or too much manual headache or not enough headcount, but you're also quantifying it. We're also able to quantify it by seeing these numbers, whereby by not integrating these different workflows, companies are really missing out and they're incurring a big expense. And in fact, we found that the best-in-class companies, the top 20% of the companies, they also integrate very effectively. This was another theme that we found that we want to, I want to tie the whole thing together that yes, you want to automate your AR processes, you want to optimize your order to cash cycle, but don't forget to tie those pieces together, to tie the sub-processes together in an effective manner. And you can see that the best-in-class companies are almost 2 times as likely to integrate their business applications so that they can serve as a completely auditable system of record so that there's consistency, and it helps with the auditing costs by keeping the auditing cost of non-compliance in check as well. And they're almost 2 times as likely as some of the laggards. And their process flows that may span different applications. They can switch on and off between these different processes, and it doesn't disrupt the overall workflow, the one which is running behind the background. So it's very seamless for them. And they can also share the data across the entire enterprise. And one of the cases I've been trying to make since last year is that e-payables, electronic payables, or payables in general, whether it's AP department or AR, is really a strategic function. It needs to be connected to the office of the CFO. It should not be just relegated to a back office function. But for the office of the CFO, the CEO, to see what's going on in the AP AR department or to see the cash flow, how it's impacting their balance sheet, they need to see how what kind of data is coming in, what the current stats are. Therefore, it's very important to share the data seamlessly across the enterprise application. As for the key takeaways from today's presentation I just covered, of course, automation is one key theme because we do believe it addresses some of the key pressures with regards to day sales outstanding or the pressure to reduce the cost or even to provide better customer service. And we believe that the improvement comes from streamlining internal processes. So you not only have to automate them, you will streamline them and improve or remove any non-value add process. So anything that's manual that shouldn't really be manual or is really impeding the overall, I guess, the speed of the cycle is something that deserves a little bit more concentration, and perhaps automation is the route to go. We talked about integration, how many feeder systems they're using, 7 on average, and what's the cost per feeder system when you're trying to integrate with the existing solution. And of course, how it disrupts the financial visibility if these systems are disparate. And then finally, we talked about the tracking, billing, and payment history is very important. This is something that I didn't really present or harp too much upon in the actual presentation, but as you can imagine, that billing and payment history is important to really tailor solutions to meet customer needs. So at the end of the day, when you're tracking or monitoring what your billing history is, what you're really trying to come up is to come up with those payment terms that are most conducive to your customers, and so that you can expand or serve your customer base better. You're not trying to lose accounts. You're trying to grow your market share and at least retain those customers that you have. And one way to do that is perhaps to customize the payment terms such that your revenue is not lost and that there is recovery and pretty much established long-term relationship. With that, I would like to thank you all for the time, and I'd like to pass it on to Ernie.
Well, thank you very much, Ankita, for that great content. Just a clarification, the webinar is eligible for CPE credits. I apologize for that confusion. You should have registered on the way in. If you have any questions on CPE, please send an email to cpe@proformative.com. As a reminder, those of you on the webinar that would like CPE credits, you need to answer all the 3 polling questions during the webinar. Of course, we appreciate everyone's consideration in answering our polling questions today. I'm going to go ahead and leave the polling question up another 30 seconds or so. And as we close down on the polling question, I'm going to introduce our next speaker. Before that, I'd like to again remind everyone we encourage you to ask questions on today's topic via the questions area box in your GoToWebinar control panel, and we will get those questions answered for you if at all possible during our Q&A session. It's my pleasure to introduce our next speaker. The next speaker is Chris Couch, Chief Operations Officer, Transverse. Chris has spent 17 years as a professional focused on telecommunications software solutions. Most recently, Chris served as Senior Vice President and Chief Marketing Officer at Ace.com Corp., a leading provider of wireless OSS, BSS, and value-add services platform. Prior to this, Chris was Chief Technology Officer at Rate Integration Incorporated, a Virginia-based software company that develops, distributes, and installs value-add services software for wireless service providers. Chris has also led consulting practices at American Management Systems and Logica, where he oversaw and participated in group up launch on several wireless carriers around the world. Chris has also designed and built wireless software products for Evolving Systems, which was sold to Lucent Technology. The products he developed include over-air activation, CDPD, and MSC to BSS mediation. With that, I'm going to go ahead and close our first polling question. And it is now my distinct pleasure to hand the floor over to Chris Couch, Chief Operations Officer at Transverse. Chris, please take it away for us. Thank you.
Thank you, Ernie. And thanks, everybody, for joining us today. And thank you, Ankita, for that pretty amazing take on AR automation and giving us the stats and the background on best-in-class companies today. I'm going to take the conversation a step deeper and talk a little bit about solutions that are available in the market and some examples around what AR automation looks like in different deployments. So just a little bit of background who we are. Transverse was founded in 2008. We were founded to serve financial professionals, CFOs and the like, by solving fairly complex AR automation problems. We focus on order management, product catalog, billing, automation, revenue recognition solutions. One of the things that we see today developing is that it's a really exciting time for CFOs and financial professionals in the industry. Never before have there been so many tools and so much available to CFOs and financial professionals in the way of technology to address problems in their back office as they never have before. We have, if you look back at what happened with Salesforce.com, you had a similar introduction with some disruptive technologies. This Salesforce came into play, was able to deliver to sales professionals and marketing professionals a technology that didn't have to come in through the IT department. It came in over a browser. It left out the need to purchase software or purchase hardware, and it gave the sales and marketing professionals access to a new capability that they've never had, and that's just continued to grow. And if you've seen this market grow over time, you've seen Salesforce bring together multiple different technologies and solutions that continue to enable sales professionals and marketing professionals to do their job better and to be a catalyst for change in their business. We're seeing that same disruption occur today for financial professionals. Today there are a multitude of technologies and products that are available for financial professionals to address challenges in their business. This is enabling finance departments to become catalysts for change, to take their businesses to a new level, to be able to address the expense equation, to be able to address the profit equation, to be able to disseminate financial information as an asset across the organization. So talking a little bit about AR automation specifically and the different business processes that are involved there. AR automation covers a wide range of business processes. Managing a product catalog, managing offers, being able to handle orders and be able to coordinate fulfillment around those orders, payment and collections, collection of usage data, processing that usage data, processing data to go into the downstream ERP systems, and handling taxation and business analytics in ways that haven't been able to be addressed before. Where AR automation sits in the ecosystem, it sits in between a number of different systems that either exist from an automated process or an automation process standpoint or manual processes. But in general, AR automation solutions will sit somewhere between the order management or the order intake function, so CRM or order management systems, Salesforce, Sugar, SAP, Oracle, NetSuite are examples of these applications on one side. On the other side, it sits as a feeder into an ERP system or payment or invoicing systems. Again, Intact, Epicor, NetSuite, SAP, some of the standards. In between that, there are other areas that these processes touch and that these functions touch. One is just the service or the company business processes in general. So on the bottom part of this screen, talking about being able to handle fulfillment through your AR automation platform. So dealing with either a service or an application, can deal with physical goods such as warehouse systems. The other side is dealing with usage or consumption-based models. One of the things that we're seeing that really challenges companies today is if they're in a business model where they have a high or they rely heavily on a consumption-based business model, is being able to being able to automate the collection of that usage, being able to process that usage sort of from an end-to-end standpoint. On the top side of this slide is the integration now more and more with customer self-care. So giving more information out to your customers, being able to provide tools for them to come in and change their price plans, to be able to upgrade or downgrade, to be able to see what their current service status is or their current order status is, are all important touch points. So the ecosystem I guess I should say there's no standard ecosystem for a back office. Right? Every customer that we deal with today, every account has had a different set of systems and processes in place. So one of the most important things about looking at automating your AR processes is understanding what can be automated today, of what needs to be planned for to be evolved to from an automation standpoint, and being able to select solutions or a combination of solutions that can span whatever your business processes are. One of the things that you're going to run into is definitely changing some of your business processes, but you're not wanting to change your business model as a whole. So the solutions need to be adaptable and be able to plug into multiple different environments. So I'm going to talk a little about an example or two here of where AR automation fits. And this is an example of a data security company that has a business model that's based on consumption and a high volume of consumption. They sell dips, if you will, into a database or transactions into a database in order to help their customers predict whether or not they are dealing with fraudulent activity. They may sell dips into this database, or a typical model for them is to sell millions, even up to billions of transactions or dips into this database at a time. Before automating their AR processes, they were dealing with fairly unwieldy manual processes that involved collection of data off of their network, dealing with a spreadsheet that was some 60,000 rows long. They were dealing with such a volume of data that there were lost orders in place. So a salesperson would make a sale or or re-up a customer, and that order wouldn't make it back to the finance team maybe for months. And then there's revenue leakage that they were dealing with from lost re-ups. So if a customer had purchased a bucket of usage and had consumed that entire bucket, if the salesperson wasn't notified, then the customer continued to consume that without being under contract. There is usually a coverage for a price for that overage, but there's always a sort of customer unhappy bill shock at the end of that. So there's always a renegotiation of what the customer should be paying. In this particular case, we came in and were able to put a system in place that, first of all, automates the order management process and ties into the fulfillment process. Doing this allows an order to be placed and makes sure that the finance team and the billing system in this case knows about the order prior to the customers being able to consume usage. That stops that last bullet point there, that revenue leakage and the lot from lost re-ups and lost orders. We make sure that the order is placed, that it can be billed before the customer starts to receive service. There's also, they automated the usage collection and processing of that usage. So now, instead of collecting that data in manual form, placing it on spreadsheets, all of that process is completely automated. That events are sent into a system, they're rated, they're priced, they're placed on the customer's account. As customers draw down their usage, different threshold notifications are set so that customers are notified about where a customer is in their consumption. Once they reach, say, an 80% threshold, then the salesperson can be notified that the customer is approaching their consumption limit and can start to discuss with that customer that what they might want to purchase as a follow-on contract. The other part that is automated in this case is the agreement management. One of the components of the business model here is that the agreements, while you purchase a bucket of usage, the agreement expires in 12 months. If that expiration occurs and the customer is still allowed to consume, then there is a lost sales opportunity and a lost revenue opportunity. By automating that process around managing the agreements, the customers can be shut off from usage or at least notified that their agreements are coming to term. So can the salesperson be notified so that the salesperson can reach out and make sure that those agreements are re-upped in time. As another example, we talk about an e-commerce Saas provider. Their business model is to build out and facilitate e-commerce transactions or e-commerce websites and e-commerce transactions for largely retail organizations. In this case, their challenges around the AR processes were first had to do with time to close the bill cycle. So closing the bill cycle is 3.5 weeks in duration. That's taking up almost the entire billing period itself. They were dealing with 6 fairly large individual spreadsheets in order to model their consumption data and their revenue recognition data. At each step in the process, these spreadsheets need to be reviewed and audited by different personnel in the organization and in the finance department so that they can avoid mistakes or misbilling customers. They also have the issue that they have complex orders and revenue recognition policies. This is a B2B company, and so each transaction that is put in place is very one-off, contract-based order. The revenue recognition there is based on different, either an agreement for total commitment of consumption, or it could be an agreement for a spend over several years at a time. In those cases, the revenue recognition gets very complex, and and a lot of times has to do with making sure that people have written the right notes down on their contracts or their sticky notes in order to enter the right information into the spreadsheets. This all resulted in some fairly high audit costs. So being able to pull reports together and get them to their auditors was also becoming a fairly unwieldy challenge for them. The approach there to automate the AR processes was first starting again with the automation of the usage collection and rating. Most of the contracts were based on an agreement to spend or an agreement to facilitate a number of transactions through their service. So collecting that data, processing that data, understanding where their customers are in that usage, being able to bill them actual usage versus the committed usage was automated. The order management component, so making sure that the complexity of the orders that were coming through was streamlined as much as possible. So working from kind of a standard product catalog and a standard set of order management processes. Automating the revenue recognition flows, so building in rules around all of their different products so that revenue recognition wasn't spread across multiple spreadsheets or notes in the contract. And then being able to produce reporting or compliance reports within a couple of days as opposed to spending several weeks on these. In this case, there were several different touch points that were integrated through the order entry system, CRM systems, tying into the service and the network components itself, and then finally tying back out into their standard ERP system. So AR automation, Ankita did a great job explaining all the different components that and benefits that the best-in-class companies are seeing through this. But from a solutions perspective, we definitely see improvement in cash flow. We definitely see improvement in revenue leakage. In fact, in almost 100% of cases of when we've gone in, we've been able to find revenue that has simply not been accounted for and not been known about. Managing revenue recognition, reducing the time and the complexity that it takes in order to perform those tasks. We see an increase in customer satisfaction. Simply bills are correct, they're more timely. Payment processes are more streamlined. Being able to, customer care representatives are able to provide more information more quickly. We see a reduction in costs, and usually we find revenue that, again, has been leaking, so there is a boost to profitability. We see time to market improvements, so being able to improve the time or reduce the time that it takes to launch new products and services, being able to increase business assurances, the financial assurance processes, dealing with auditors, dealing with boards, producing more timely, more complete compliance reports. Again, it frees, as Ankita had mentioned, it frees resources to apply to other parts of the business, and not insignificantly helps reduce the number of manual steps, which in the end reduces the number of errors that you receive. So with that, I'm going to turn it back over to you, Ernie. And
thank you very much, Chris. Appreciate your great thoughts and insights. I'm going to go ahead and launch our next polling question as we jump into the Q&A. We only have time for a few questions, but please feel free to ask your questions, and we'll follow up with the speakers afterwards to get your questions answered. First question is going to be for you, Chris. When do you see a company on the warning signs of when they are ready to automate to AR and can justify that investment? What are the characteristics of their businesses?
Sure. It changes from business to business, but some of the common themes that we see are it's taking longer and longer. The time to close the billing period is approaching the length of the billing period. So if your billing period is a month, and the time to close that billing period is 3.5, approaching 4 weeks, it means that you need to probably add more headcount in order to add more customers. We also see some indicators around if it's a transactional or high volume type of a business, consumption business, that dealing with spreadsheets, dealing with 60,000 row spreadsheets in order to try to process usage is an indicator. Trying to deal with revenue recognition policies that are require notes that are handwritten in contracts or on sticky notes posted on somebody's desk. Once you start to see level of volume there in customers, that becomes also sort of an unsustainable, scalable problem.
Okay, great. Thank you very much, Chris. Time for one question for Ankita. Ankita, you mentioned that the survey results were year over year. Can you just comment as to this year's results, what you found were the most surprising, and if there were any trends that you saw by industries?
Sorry, Ernie, you were breaking up quite a bit. Is there a way that you could repeat that question?
Yeah, sure thing. What did you find were the most surprising results from the survey this year, and are there any trends by industry or company size you can speak to?
Sure. So that's a really good question. I think most of the surprise, we weren't really, there weren't that many surprises in terms of technology trends. We expected automation, of course, and as I mentioned earlier, there is overall emphasis on improvement, especially for the leading companies. And the other aspect is integration. And I think Chris does a great job when he was playing out of SAP, Salesforce, and where does it, within the CRM system, where does it sit? So I think that pretty much ties the picture for integration. In terms of overall trends, one thing I do remember mentioning in the webinar as well was that I mentioned 32% of the respondents are considering or have some applications in the cloud when it comes to their AR automation processes. And I believe around 26%, this is based on the same study, we found are in the initial or evaluation phase, and only 10%, 100% cloud-based as it stands today. As for some other trends I can think of, mobile, it would be for invoices. Many are moving towards handling the invoices, and it's currently around 9% for some of the leading companies. So it's even slow for the leading companies, but I have to say the laggards are not even anywhere on the map in that aspect. So best-in-class companies are looking at mobile deployment at about 9%. Industry average is somewhere around 2%, and then the laggards are not considering it yet. They are very far behind. Any other specific trends I could think of? Again, the integrated order entry, procurement planning, and fulfillment, along with financial management, that's something that's really big with lots of executives. The current rate is around 45%, but we do believe somewhere around 28 to 30% of the executives are looking into these kind of integrated platforms and to streamline the processes. And on similar lines, web-based electronic sales order management is another area where we are finding that executives or the companies are gaining some momentum, some traction. Current rate is around 30%, according to one of our surveys we just did this year. And I believe around 24% are looking in terms of the future trend. So they are looking at web-based electronic sales order management systems. So those are some of the high-level trends that I can share with you right off the bat.
Great. Thank you very much. I'm going to leave the final polling question up just a few more seconds. In the sake of time, we're going to have to close the Q&A session. Again, we will follow up with the speakers afterwards for any questions that we did not get to. As a reminder, you'll be asked to take a survey once the webinar concludes. Greatly appreciate your feedback on the event, as we always strive to improve the ROI for your valuable time. A big thank you to Chris and Ankita for their time and insights. They're clearly thought leaders in their field and an excellent source of information on today's topic. Note in the post-webinar survey you have the opportunity to express your interest in being connected with either or both speakers or our sponsor, Transverse, with just a few mouse clicks. A thank you again to today's sponsor, Transverse, and a big thank you to the audience for your valuable time. We hope to see you again in another Proformative event or online at www.proformative.com. Make the rest of your day great, everyone. Thank you very much.